So I like sitting on the edge like this. You can lean back if you want.
They're pretty soft chairs, but I might fall right back into it if I don't.
Frank Drews just was forward first, and then he went back yesterday, and it all worked out perfectly. So let's go chronologically and start with your Bachelor of Commerce from Concordia. And you said the best experience for you at that time was a portfolio manager program that you were a part of. What was so great about that for you?
Yeah, so in my undergrad, I got to run a $1 million real money portfolio with 8 of my fellow undergrads at Concordia. And so we ran a $1 million portfolio, and the investment committee we had to present our ideas to had the chief investment officer of some of the largest pension plans in Canada. Bell's pension plan, CN pension plan. So the rigor and process that went into presenting our ideas to them was very, very impressive. And obviously running real money, very practical, was a great learning experience for me.
And so you took some lessons from that and applied it in your future career.
Absolutely. And then I graduated, working as portfolio manager for 8 to 10 years at my job, and I look back on my university career, which I love. I love my alma mater, I love the university, but I realized that 95% of what I learned in my finance theory classes were not all applicable to what I did day to day as a portfolio manager. So I went back and created a class called Applied Investments, and basically it was everything I wish they taught me in university, but they never did. By the time I graduated, that could really help me in a job. So there's no textbooks, all practical case studies. We studied Warren Buffett, Peter Lynch, technical analysis. The students really loved it, and it was a great way for me to be in touch with the energy and the dynamism of the youth that wanted to learn about the stock market. So that was a great experience as well.
Moving ahead to the early 2000s, you start what began a 17-year career at Formula Growth Limited. What was your first role, and what was your path to eventually becoming co-manager of the Alpha Fund and then the Focus Fund?
Yeah, I think in life to be successful, you have to work really hard and get a bit lucky as well. And so when I joined Formula Growth, I had a background covering energy in university, and nobody at the firm covered energy. The last time they bought energy stocks was literally the 1970s. So I was able to convince them that energy stocks could be growth investments too, and there's a good way to make money in this sector. And luckily for me, oil went from $30 a barrel to $140 a barrel when I picked up the sector. So you don't have to be that good at stock picking when the sector is at your back, as it is back then. So that was a great first experience for me. That branched out into covering all commodities for the firm after the success we had in oil and gas at the time. Then I became a generalist fund manager where I covered multiple sectors. Then in 2013, I took over a market neutral fund called the Formula Growth Alpha Fund. It had a very small asset base, $15 million of assets. I took it over with my then partner and my now partner, Charles Hager, and we grew that from 15 million to about 500 million of assets under management in about 5 years. Became one of the most successful market neutral strategies in Canada. And then after that, in 2015, we were sitting in an airport at LaGuardia. We obviously loved running the market neutral fund. We said, you know what, what's the thing we make the most money on in our lives has been investing our own capital. And what strategies do we use investing our own capital in the markets? And it was concentrated positions in small cap companies, large bets, high percentage bets of the portfolio, and our highest conviction ideas. So we, at the back of an envelope at LaGuardia Airport in 2015, we created the idea to launch the Formula Growth Focus Fund, which is exactly that. A portfolio of maybe 10 or 20 stocks, 5 to 10, 15% positions in your highest conviction names, long, short, and that strategy did extremely well as well. So that ended up growing to about maybe, between the two funds, about 750 million of assets by the time I left in 2018.
You mentioned Warren Buffett. He was an early hero of yours. You have always taken a value approach. Of course, you love Benjamin Graham as well. But you also developed at an early age as a teenager this contrarian bent. Yeah. Because during the tech bubble, you were investing your own money in so-called old economy stocks, which turned out to be a brilliant move. So where do you think that came from to have the wherewithal to think that way? Because most kids that, if they had money then, they'd be saying, I want to buy, Cisco, Nortel, or whatever. Yeah.
No, I remember, I guess I've always been a bit of an old soul at heart. I remember in university in Cégep, which is like a kind of high school equivalent in Quebec, I was the only person I knew that didn't buy a single .com stock during the tech bubble from like 96 to 2000. Because I had that background in fundamental investing, cash flow, real intrinsic value, I realized early on it was a bubble. Probably I should have bought some of them just to play the speculative side of things, but I didn't buy a single stock. I remember the library was full of university students buying pets.com and bozo.com, whatever they were buying in the library, and I was buying CN Railroad, and I was buying Kellogg's, and I was buying the old economy stocks that were
boring. Those will never work.
No longer valuable. We didn't have to eat anymore. We didn't have to have trains delivering food to our families. But they're trading at 50-year low valuations. Like you could literally buy CN Railroad in the 90s at 3 times EBITDA. It was ridiculous because everybody had switched into tech. So that served me well when the market crashed, and those stocks did extremely well. So I've always kind of kept that contrarian streak, and obviously in the commodity sector, a contrarian streak is actually a very good thing. It's how you can make a significant amount of money over the full cycle.
Michael, you've said at Formula Growth, 2 of your bigger winners in the metals sector were Richmont Mines, and the other one was K92. Mm-hmm. So What do you recognize in those two, and why did they work for you?
Yeah, I've always been in small caps. I always believe if you're going to be an active fund manager, you've got to be in inefficient markets. So by being in small caps where less managers can look or physically invest money because they're too small companies to invest in, you can find a lot of inefficiencies. Being in small caps too, you're at the front row seat of transformational changes. So especially in our business, in the commodity business, you can make transformational, disruptive discoveries that can turn a company from a below average marginal player to a significant player almost overnight. And so both K92 Mining and Richmont Mines almost had the same playbook in terms of how they became, for me, 10 or 15 bagger investments. They were both kind of 40,000 ounce producers, high cost, low, short mine life producers, very marginal, probably sub-economic producers. But they both made major, high grade, very large discoveries within the shadows of their existing infrastructure. So almost overnight, they went from short mine life, high cost to long mine life, low cost producers with very high grade production. But the market being what it was, these small cap stocks, not many people knew about them. So we had the time to build a very large position in both companies before the market woke up. Whereas tomorrow, if Barrick or Apple or Microsoft puts out big news tomorrow, the stock re-rates within 6 hours, is fully re-rated. In the small cap space, especially in bear markets, it can be much longer. So those had the same textbook. Both ended up being up 10 or 15 times original investment, but we had the news in hand when we were buying the stocks, which you don't typically get in a large cap arena.
Was there one or two moves, or were there one or two moves where you kind of went, that didn't work, you made a mistake, but you learned from it?
Absolutely. John Dobson was a wonderful man. He passed away. He was my first mentor in the business. And I think my first week on the job, he said, Michael, I don't care if you make mistakes. You learn a lot more from your mistakes than you do from your winning stocks. And that is so true. The files in my office where I've lost money, I'm old school, I still write by hand, are like this thick. And the ones where you made money are very thin because you think you're very smart. Stock just goes up, you don't ask yourself any questions, you pat yourself on the back, right? So over the years, I've made many, many mistakes investing. But what I would try to do is when I make a mistake, I learn from it and try to repeat the mistake in the future. And some mistakes, balance sheets. Balance sheets are so important. When things are good and the sun is shining, you can have a lot of leverage. When things go south and the business turns, that's how you can lose 100% of your capital very quickly in an over-levered balance sheet situation. Cycles matter. I think we're all here. I'm very confident we're at the bottom of the market for the gold sector. But as you all know, you can have the best gold project in the world right now. Your stock's likely not going up because the tide's against you. Whereas if you're in lithium or uranium right now, the wind's at your back. So the best stock in the worst sector will still lose you money, whereas the worst stock in a great sector will probably make you money. So stock picking is important, but knowing the cycle is extremely important as well. And I'd probably say the final one would be management. A lot of you are management teams here. I really like management that own a lot of stock. Not that the management that don't own stock are not good, but when you're an owner of a company, you'll be staying up till 2 or 3 o'clock in the morning trying to find solutions. You're going to be not taking that overly dilutive financing to keep the lights on. You're going to think like an owner and act like an owner. And so when I invest in companies that don't own a lot of stock, sometimes the decision making is not always aligned with the shareholders' interests. So
in 2018, on the personal side and on the business side, you had 5 children looking at you under the age of 8, you've said, including twins. And you thought to yourself, my current job is not conducive to raising these kids properly. And at the same time, we're going back to 15 or so, you had really gotten interested in investing in gold.
Yep.
So that sort of weaves through the story to get you to the point where you start working from home and become this strategic investor that you are now in the metals sector. So can you sort of take us through that?
Yeah, I'm very blessed to have 5 beautiful girls at home. I had 3 girls under 8, and then my wife gifted us with twin daughters. So I love my job. I'm very passionate, as you can tell, about the stock market. I love my job, love the company I work for. But 5 kids under 8 was really not sustainable. I was traveling 1 or 2 weeks out of 4 on the road, and it was just not possible to continue. It was a world pre-COVID, before virtual teleconferencing. You had to travel everywhere to get in front of companies. So yeah, in 2015 at Formula Growth, I really got attracted to gold, kind of my contrarian streak. As you recall, gold was $1,100 an ounce. I remember the headline said, gold's a relic, it's going below 1,000. The mood was dire and very sour at every conference I went to. So we started investing money professionally in gold at Formula Growth 2015 to 2018. When I left for those family reasons in 2018, I was sitting at home, obviously wanted to be an active investor, had a decent amount of capital, and I could never go down to microcap stocks professionally before because they were just too small. So I started writing a couple of checks to junior explorers because gold had gone from 1,100 to 1,350. The sector was starting to improve, but the juniors were still dead. They had no capital from 2013 to 2018. So you had projects that had made significant discoveries in the last upturn and literally been stalled for 4 or 5 years because they couldn't get any funding to move them forward. So it was kind of like shooting fish in a barrel, to the sense that you'd already made the discovery. You knew the project was a really attractive project, but you're getting it at a greenfield, early stage exploration valuation. So I cut a few checks. It worked out really well. But when I got under the hood, of these companies, and I don't want to offend anybody in the room, but a lot of the junior exploration companies that I met either had one or two attributes. They're either run by financiers that knew a heck of a lot how to raise money, but didn't know a lot about mining and exploration, or run by explorationists who knew a lot about finding gold or deposits, but didn't know a lot about raising money. And so I said, well, I can be a passive investor and just write these checks and hope that the stocks work out, or I can roll up my sleeves and get involved and try to add value. So I wasn't an activist investor, but I would probably call myself a proactivist investor. So if I became a 5 or 15% shareholder of a company, I said, well, why don't you add so-and-so to your board? Why don't you get some help on the marketing side? Why don't you bring a technical expert on the geology side to try to improve the quality of the management teams in the junior exploration sector? So adding value to my investment by rolling up my sleeves as well. And that worked out really well. Ended up doing 20, 25 investments, joining 4 or 5 boards, advisory positions, but always as an equity holder. Like I've charged very, very little or nothing for my services. I find companies that I want to back, and my return on equity is going to be the return on the investment that I have in the company. No, I'm not looking to generate cash flow or salary from this.
So you have 6 key criteria that you look at when you're examining and assessing exploration companies. Can you run through those for us?
Yeah, and these are broad criteria. I would say go much more detail when I get into the nitty gritty, but kind of a high level, I'd say obviously first geology is king, right? You can't change geology. So for me, the top 2 things, obvious but very important, grade and scale. For me, grade is margin. You know, how much margin you're going to make per ton of whatever you're moving and trying to sell, and scale, is there enough of it to justify the capital required to build a mill and the plant and equipment. So that's the first screen. Second is infrastructure. I mean, obviously projects that have established infrastructure have an innate advantage. If there's roads, there's power, water, there's an existing mill or tailings facility, what that does is that just lowers your CapEx hurdle. It means you have to put less CapEx in the ground to make that project a go. And therefore, you need less grade and less scale to have an economic project. So that's another key factor that I evaluate. I'll invest in projects that have no infrastructure, but I'm very aware that you're going to have to make a heck of a discovery, a very large kind of tier 1 discovery, to justify the infrastructure necessary to bring that mine into production at some point in the future. Thirdly, I would say management, very important to me. And like I mentioned earlier, you ought to have the right combination of both financial and technical skill. And for you geologists in the room, I have a term called commercial geologists. So I love geologists. My daughter's actually very interested in geology. I love the science and the thrill of learning about new areas of geology. But what I like to see are geologists that have a bit of an idea of capital allocation. And what do I mean by that is if you can learn a lot by drilling, but I'd rather not learn with drill dollars. I'd rather learn by finding commercial deposits. So a geologist can say, look, we have 10,000 meters planned. The first 3,000 meters here are not giving us what we expect. Let's kill that program and allocate capital somewhere else in our portfolio where there's a better chance of making a commercial discovery. I don't want to spend money to learn about geology. I want to spend money to make commercial deposits. Jurisdiction, very important. And for me, jurisdiction is how quickly can a mine come onto production and how safe am I in terms of title and taxation around that. And then finally, the other 2 would be cycle. I talked about that earlier. Where are we in the cycle? I want to be when the wind's blowing at my back, preferably at the bottom of the cycle. And finally, valuation. I'm looking to make anywhere from 10 to 50 times my initial investment when I take the risk of investing in an early stage exploration company. So if I'm starting off by paying $200 million market cap or something, it's got to be $2 billion for me to make 10 times that money. It's possible, but the project has to have that kind of pedigree to make me 10 times. Where if I'm coming in at $10 or $20 million valuation, that's a $100 to $200 million kind of exit multiple kind of thing on that. And so it gives me more room to make that kind of return.
Right, we're going to talk a little bit more, you're going to talk more about your formula, the risk-reward formula there. But let's stick with jurisdictions just for a second. And you say that you can't paint them all with the same brush. And an obvious example, just off the top of my head, is Canada's great and Africa's too risky. And that's not necessarily the way to look at it, correct?
Yeah, I think investors have that mentality. Canada, USA, good. West Africa, bad. Canada, USA, good. South America, bad. And I think all jurisdiction is hyper-local, right? There are parts in Canada, as you know, and USA where it is impossible to build a mine. So you have a good address, but a very bad zip code, right? And the same thing you have in other less desirable jurisdictions where you have a bad, let's say I don't want to invest in West Africa, but some countries in West Africa or Latin America, you can go from discovery to production in maybe 3 to 4 years. Where that same mine in Canada, even a good jurisdiction, is 12 to 15 years. Well, that has on your net present value on discounted cash flows by pulling forward a mine by 10 to 15 years, has a dramatic impact on the value of that company. And so investors will assign very, very high discount rates to less desirable jurisdictions and very low discount rates to desirable jurisdictions. And again, there's a lot of inefficiency in that pricing. So I'm open to any jurisdiction at the right price if I can get comfortable with the pathway to build a mine and not just be too generic by saying I don't touch these because X, Y, Z.
Also, it's still with assessing companies. You say you take an institutional mindset. What do you mean by that?
Yeah, so when I went way down cap 4 or 5 years ago into the junior exploration space, I've been investing in producing assets for over 25 years as an institutional investor. And so what I tried to do is kind of reverse engineer what are the attributes of a producing mine that allowed it to be a producing mine, and then re-extrapolate that on a really early stage exploration, even a pre-drill kind of greenfield discovery type situation. And that's where my list of criteria came from. What are the things that kill projects? And if a company has one of those red flags, it doesn't fit one of those criteria, I'm not even going to invest at the pre-exploration stage, because I know what a mine looks like. And so you can say no a lot easier when you know why you're saying yes. And so bringing that institutional mindset to, I kind of call it the Wild West of junior exploration, because there aren't a lot of institutional investors that operate in this space, and therefore the market is extremely inefficient. So the other edge I have is bringing that institutional work ethic and mindset to the junior exploration sector, working hard like everyone does, but having a focus on where less competition. It means you're more likely to find mispriced opportunities versus the large caps, which are much more followed.
So you've said, Michael, you're not looking for doubles and triples, you're looking for 10x, 50 times your investment.
Yep.
You've got a formula too, where you can just paint it simply with sort of kind of a metaphor, an easy image. $100, 10 stocks, what's the risk reward? What's the formula? How does it work?
Yeah, I mean, I don't want to be a downer here, but I think you all know that. I'd say 90% of the companies in this room are never going to become mines, right? And you guys are the creme de la creme, which means you're actually public and you've got capital. So that is, unfortunately, the reality of our business. So if you understand the math behind our business, if 9 out of 10 in this room are not going to become mines, well, the ones that do become mines have to make you a heck of a lot of money to pay for the mistakes. So I kind of take a venture capital type approach to the mining sector. I mean, venture capital is very well adopted, very well funded in the tech sector. In the mining space, it's not as well understood, but it's the exact same business model if you look at it in detail. Venture capitalists in Silicon Valley will seed 50 early stage tech companies, knowing full well that 90 to 95% of them are going to be zeros and not going to work out. But one of them might become Google, one might become Facebook, one could become Amazon, and that 50 times return or 100 times return pays for all the mistakes in your portfolio. But they're not mistakes because you know it's part of the process. Where in the mining space, I don't find we have that similar type capital allocation or thought process. So I do a very simple example for simple math. Let's say you have 10 stocks, you have $100 in your pocket, and you put $10 in each stock. They're early stage junior exploration companies. 8 of them go to zero. One goes from 10 to 200, goes up 20 times, and one goes from 10 to 100. Well, at the end of that process, you're left with $300, even though 8 of your 10 investments went to zero. And so with that institutional ethic, I'm trying to get to that 10. And if I can bet 20%, that's well above the 1 in 1,000, or maybe 1 out of 10 in this room that become mines. And that return is what gives you the overall return. So I've got to make a lot of money when I'm right, because I know I'm going to be wrong. And so it's a VC approach. And I wish our industry or the funders of capital in our industry looked at the mining sector through that lens. I think they could make a lot of money. It would obviously improve the health of the industry tremendously. Instead of having these kind of shotgun involvements where if it goes bad, you swear off mining for the next 20 years, be more thoughtful and allocate capital in a more distributed fashion.
Now, I would think most of the people in this room know about the Lon Curve from discovery to production. And this is a little cocky of you, I may say. You have the Lon Gentile curve.
Yes.
What is that? How is that different? What is it?
Yes, I in no means am tying myself to, I couldn't tie Lon shoelaces currently, but I do have a lot of respect for the Lon Curve. I think it's a brilliant way of framing the evolution of value creation in our industry. But leaning on my 25 years investing in commodities, what I've learned the hard way is 95% of your return does not come from the movement from exploration to discovery to production. It comes from where's the commodity going. So if the commodity is going up, you're making money. If the commodity is going down, you're losing money. And the Lon Curve might skate you on side to lose less, but you're still going to lose money if the commodity is going down. So what I've done is I tried to take the Lon Curve and downshift it and upshift it. And that's the kind of the Gentile contribution to the Lon Curve. And what I mean by that is I like to invest contrarian, as you mentioned, Mark, the bottom of a cycle. When everybody hates a sector, like they hate gold right now, but the macro outlook is very, very positive, the Lon Curve shifts down. What I mean by that, 6 months ago, lithium space was the hottest thing in the world. A grassroots, greenfield, never been drilled lithium project would probably have a $50 million market cap 6 months ago. They're down, but they're still pretty frothy. The same project with the same kind of geological chance of success in the gold sector would have a $2 million market cap today. So same Lon Curve, same stage. I'm paying $50 million for one, I'm paying $2 million for the other. Where am I going to make more money? Probably in a $2 million investment, right? So I like to try, look at the Lon Curve and say, can I find the ones that are downshifted? So when the sector turns, even before I make a discovery, that $2 million market cap goes to $50 million. And if I'm fortunate enough to make a discovery, it might go from 50 to 200. And that's how you can make 10 to 50, 100 times your money. If you're investing at the high end of that shift and you're putting 50 million in Explorco, well, if they don't make a discovery, it's going to zero. And so your downside is significantly higher or riskier investing when things are frothy. So it's just shifting a little Lon Curve up and down, which is, I think, an interesting part of the discussion.
Let's shift to the, speaking of shifts, we'll go to on the macro front. We had Frank Juster here yesterday, Rob McEwen. They had some really interesting things to say about where they think the state of the world is. A lot of their comments, especially Frank's, were kind of gloomy, really. What do you think of the more than 300 trillion globally in debt, and what are the repercussions, and what are the possible ramifications? Is there a crisis coming? If so, what does that look like? How does gold fit into this scenario?
It's funny, Mark, I'm not Johnny come lately. I've been talking about this debt problem for multiple years, and luckily, thanks to technology, there's interviews of me on YouTube from 2020 where I talk about it. But in 2021, I was doing interviews saying, we got a real debt problem in the G7 countries, but rates are 0%, so no one's paying attention. And I remember doing interviews saying, if the $30 trillion of debt we have, if interest rates went from 0 to 5%, we would have a serious fiscal problem in the United States, which is the risk-free asset of the world, right? Well, that's no longer a fantasy or a hypothetical exercise. I mean, 2 weeks ago, the 10-year yield kissed 5%. And so just to kind of rehash those numbers in real time for your audience, there's currently $34 trillion of debt about in the US right now, growing at a hyperbolic rate on a daily basis. If you assume that debt's going to refi in the next 3 to 4 years, which is kind of the math behind it, at a 5% interest rate, that's $1.7 trillion a year of interest expense. Now, to gauge your perspective there, in 2022, the US government took in $5 trillion of revenue. So 1.7 trillion of interest on 5 trillion of revenue is over 30% of your annual revenue going to pay off the interest on your debt. Forget about paying down the debt at all. That interest level was $300 million a year when Donald Trump took office in 2016. So in 6 years, your interest expense will have gone from 300 million to approximately 1.7 trillion, a 600% increase in your interest expense. To scare you a little bit more, the number one payment in the US budgeting system is Social Security at 22% of revenues. The interest on the debt is going to be in the low 30s. Defense spending and healthcare between 10 or 15%. So we're going to be paying 3 times the amount of money on interest expense that we spend on healthcare and defense in the United States of America. That is completely unsustainable and smacks of emerging market economies that have debt crises that blow up. And I think you're starting to see that in the bond market, that the yield has started to blow out, not really react well to negative economic numbers because I think the market knows there's a problem of being able to place all this debt. Who's going to buy this debt when we know we can't pay it back with dollars that are worth anything in the future?
The US 10-year, speaking of the bond market, recently was over 5, very briefly. They've come back to around 4 or 6. I haven't looked today, but is the bond market telling us that forget about the Fed, forget about the economy and so on, they're more so looking at the debt problem you're talking about, so-called, not so much vigilantes, but they're driving the bus now in a way, and the Fed's maybe lost control?
I think it's the first time in my lifetime, probably many people's lifetimes in the room, where the questioning of the US fiscal ability to repay their debt is in question. And that's a real major problem, and obviously very, very bullish for gold, and I can elaborate a bit more on that. If you look at who's bought the debt, well, the debt's gone from 10 trillion to $34 trillion. If you look at that 24 trillion of debt, who's been buying that debt? Well, the Federal Reserve has bought about half of that debt over the last 5 to 10 years. Well, the Federal Reserve stopped buying debt. So your biggest buyer, if you have a stock, I saw this on LinkedIn or Twitter, so it's not saying it's my creative idea, but if you have a stock where, say someone's buying 50% of all the Apple shares on the market, nonstop for the last 10 years, and all of a sudden that shareholder stops buying Apple stock, what's going to happen to Apple stock? It's going to go down, right? But not only do they stop buying Apple stock, the Federal Reserve is actually selling bonds now. So they've become, you're buying half the shares in the market, now you stop buying, now you're actually a net seller of Apple stock. So that's what's happening in the bond market. The biggest buyer is now out. The second biggest buyers have been the Chinese, the Russians, the Indians, although BRIC countries. Ever since the US monetized the US dollar or made it a weapon of war when they froze the Russian assets during the Russian-Ukraine conflict, those BRIC countries have been selling US treasuries as fast as they can and rotating their money into gold. So your 2 biggest buyers are no longer buying, they're selling debt. That's a major, major problem, especially the fact that you're issuing $1 trillion or $2 trillion of new debt every single year. So normal market dynamics, if you've got too much supply and not enough demand, the price has to go down, which means yield have to go up. The last piece of the puzzle is what do you do if you're selling your treasuries, right? So if you're the Chinese or the Russians or the Indians, you're selling your treasuries, what are you going to buy to replace that new reserve currency status? And the US dollar is about 67% of the total reserve currencies of the world today. Gold is 7 of that, okay? You're going to buy the yen. I'm pretty sure you're not going to buy the yen. You're going to buy the euro. I don't think you're going to buy the euro. You don't have a lot of options if you're selling your US treasuries to replace it with something as a reserve asset in your balance sheet. And lo and behold, what we've seen the last 18 months is record gold buying by central banks. So that rotation out of the US dollar into gold, I think, is a mega trend. It's not just a 6-quarter trend. As they continue to lower their exposure to the US dollar, and that money rolls into gold, if you take gold from 7% of total reserve assets to 10, the impact on the gold price could be exponentially wild. And so that's my comp. I'm not here saying BRICS currency tomorrow, US dollar is going to lose the reserve status. I'm a pretty sober, kind of calm individual. But I would say that it's no doubt the market share of the US dollar is going down, and that's going to be a direct benefit to gold. And you're already seeing it live at where the money is flowing. So it's very, very positive. It's surprising that equity investors have not quite woken up to that reality yet.
And do you have a view on, and could this exacerbate things, this so-called de-dollarization of the globe, whereby you've got China, Russia, India, Iran, BRICS plus,
Yep.
And a lot of their deal making in oil, for example, is being done in yuan.
Yep.
So what's your view on that?
I think the weaponization of the US dollar, a lot of these countries said, look, if I end up in a conflict with the US, let's be honest, most countries have been in conflict with the US at some point in the time over their history. They're reluctant to hold their currency reserves in a country that could freeze their assets arbitrarily. So you're seeing the petro yuan, you're seeing the Indians trading with the Chinese, the Russians trading with the Chinese. Again, that speaks to my thesis of it's not we're replacing the reserve currency tomorrow, but we're chipping away a % or 2 every year at the margins of the dominance of the US dollar. If you read, Ray Dalio's got some great ultra long-term history themes on cycles of currency. The reserve currencies, they don't crash overnight. It's a slow erosion over kind of 10, 20 years where the country gets over-indebted and slowly loses its status of reserve currency. I think you're seeing that in real time. So I don't think you need a BRICS currency or a big announcement tomorrow. It's going to be a slow erosion where the gold and other currencies are going to get more and more prominence versus the US dollar.
All right, so we're going to do Q&A in a while. We should have a good amount of time for that. But having said that, with that as the backdrop, I'm sure this audience would like some ideas. You've got 20 plus investments in junior exploration companies. You break them down into various categories as to the level of advancement, essentially. So can you give us some names that you own, that you're involved with, and why you like them?
Perfect. It's kind of, I have 5 kids. It's kind of like choosing between your children. So
right.
if I don't mention some of my other companies, not because I don't like them, but what I want to do is maybe, we talked about Lon Curve, give you some companies per grouping in that Lon Curve type. So I'd say my 2 favorite producers currently right now are K92 Mining and Calibre Mining. Both similar stories. They have very nice low-cost production, generating free cash flow, but more important to me, have very compelling exploration upside. So every day with the drill bit, they're adding more and more NAV. And both stories, I think, are dramatically undervalued here with the pullback in the market. In my next category, I'd call them developers or very likely to be mines this cycle. There's 3 companies there. I say it's Ariane Phosphate. It's based in Quebec. It's fully permitted. I think it's going to be a key player in the battery revolution that we're seeing, the electric vehicle revolution. Again, the market's going gaga and crazy over lithium, but LFP batteries, there's a P for phosphate in LFP batteries, and the market's not paying attention to phosphate. Trades at a small fraction of the valuation of lithium companies is quite interesting. I'd say Cerrado Gold is another one, which is actually at this conference here today. Put out a really nice feasibility in Brazil, really nice economics, trading at a fraction of its value. And Arizona Sonoran, who's also here today, really nice brownfield copper project in Arizona with a nice permitting pathway, really good economics, and a proven CEO in George Ogilvy at the helm, who I have a lot of trust to execute well. The next tier are, I'd call them advanced exploration assets that I think are a year or 2 away from being in the developer category and being in that next category of mines to be built this cycle. Arizona Metals, AMC is a ticker, probably the highest grade, most exciting copper gold project I've seen in my career. 2 to 5% copper in Arizona, nice tonnage, really good grade, low capex. Most projects have very high capex in the copper space, as you know. This will be a low capex, high margin, potentially very large scale operation. Northern Superior Resources and Radisson Resources in Quebec both have very large resource endowments, very good jurisdiction, very good infrastructure in place. North Isle, copper and gold in BC is another good one, and Roscan Gold are all mines I think are going to have a really good shot to get built this cycle. Bear with me as I go through my children here. And then finally, the exploration companies that I think have a really good shot to make transformational discoveries. Group 11, who's here today in Ireland, really exciting zinc, silver, uranium discovery made it last year. Unfortunately, the market's not paying attention, but it's a really, really exciting geology discovery. Galantis Gold in Ireland and Scotland, another really exciting project. And Murchison Minerals, it's a nickel project in Quebec. So that's just some of my children in my portfolio, but I love them all. And they're all very, very exciting stories.
All right, I think we got a glimpse into pretty well your entire portfolio there.